Welcome to our discussion on Chapter 5, Bonds and Bond Valuation. This is a key concept in corporate finance. In this session, we're going to explore how bonds work, their various features, and methods used to value them. By the end of this presentation, you should have a solid understanding of the bond market, its importance, and how these instruments are priced. So let's get started. Piece of the big picture looks at the cost of issuing bonds and the risks of the economy and the company impacts, those costs, and also then the returns to investors. What are the key features to a bond? A bond is essentially a loan made by investors to a borrower, typically a corporation or a government entity. Bonds are crucial to funding long-term projects like infrastructure, research, or expansion. For example, Tesla issued $1.8 billion in bonds in 2017 to finance the production of its Model 3. Bonds have primary characteristics, right? They have the face value, which is usually $1,000, the coupon payment, and the maturity date. So let's look at some of these a little bit more detail. The coupon rate, that's the annual interest rate paid on the bond's face value, always $1,000. Maturity, time until the bond receives its face value. That is, how long is the life of this loan? Yield to maturity, if you buy the bond today and you hold it to maturity, what is the return on average on your investment? A discount bond is a bond that's priced below its face value, and a premium bond is priced above its face value. Apple issued a 30-year bond in 2021 with a coupon of 2.65. If the market rate increases above 2.65, this bond is going to sell at a discount. So if the market is going to pay more than what this bond is willing to pay, the 2.65%, we should see a decrease in its value. There are some provisions or applications of bonds that we need to be aware of. The first is something called a call provision. This provides a process for corporations to refinance their debt, much like we do when we refinance our mortgages. There is a specific process and costs to the firm. So when do most people refinance their homes? When interest rates fall far enough. Well, how far is far enough? It's a mathematical calculation. But in general, when the future costs are less than the current costs, that is when we would want to refinance. A sinking fund is a mechanism for companies to strategically pay off their debt over time. A bond is an interest-only loan. Through systematic payouts, companies can reduce the debt burden, much like we do when we pay a car loan. However, they're not required to do that. It is, again, interest only until maturity. So companies can set a strategy to pay off a certain percent every year. Now, of course, they're going to look at the price. If the rates have fallen, then the price will rise. If they're above the call premium, the company will just simply call the debt. But if the price is less than $1,000, right? If interest rates have gone up, prices have gone down, that means the price goes down. That means it would be cheaper to buy back the debt from the market at a price less than the actual value on the financial statements. An alternative, of course, would be just to put this in a temporary place until prices move in the right direction. So let's look at some valuation. There's a worksheet that has this information for you. The value of a bond is the sum of the present value of the remaining coupon payments plus the present value of the maturity at the end of the bond's life at whatever the required return is for the bond. Bond prices and interest rates have inverse relationships. When interest rates rise, existing bonds with lower coupon rates become less attractive, causing their prices to fall. Conversely, when rates fall, bond prices rise. For instance, during the COVID-19 pandemic, central banks lowered rates. This was boosting bond prices globally. So understanding this relationship is crucial for bond investors. As a bond investor, you want to have an understanding not where interest rates are today, but where interest rates are going to go in the future. So what would happen if inflation rose by 3% for this bond, which then would cause the required return to increase by 3%? So now the required return is 13%. You can see that the bond value has dropped from $1,000 to $837. So when interest or inflation or risk goes up, prices go down. What happens over time? At maturity, the value of any bond must equal its par value. So the value of a premium bond, in this case a bond selling for $1,372 today, would eventually decrease to $1,000. A value of a discount bond, currently selling at $775 at maturity, would sell for $1,000. So the idea here is that bonds have fixed returns. You know exactly what the coupons are. You know exactly what your capital gain will be if you hold to maturity. Just a few definitions about bonds. We have something called the current yield. This is the coupon payment divided by the current price. This equals, if you buy the bond today and you receive this coupon over the next year, that's the return that you'll make on the money that you invested today. Typically, it's a little bit higher than the capital gains piece. Now, the capital gains yield is the change in price divided by the beginning price. So if you look at the total return of an investment, it's yield to maturity. That's what you would earn. That's what the total you would expect to get if the bond is held to maturity. That equals the expected current yield plus any expected capital gains. Sometimes this is also called the promised yield. Again, one of the assumptions is that the bond will not default. For that type of analysis, we would need a more of an investments-oriented kind of a course. So for this particular bond, it's a 10-year, 9% bond, coupon, 9% annual coupon bond, has a $1,000 par value, and it's selling for $887. What would the yield to maturity be on this bond? You see the yield to maturity here is identified as 10.912%. So if you buy today and you hold to maturity, you would average 10.912% per year on your investment. So what is this relationship between coupon, required returns, and value? So if the coupon rate is less than the required rate, we say that this bond sells at a discount. Well, let's talk about how that happens. Again, we know that there is a relationship between the required returns and the coupon rate. Think of the coupon rate, that's what the company wants to pay you. The required return is what you want to get paid. The company wants $1,000 for this loan. Now, if the company does not want to pay you what you want, you're not willing to give them all the money they want. So you would buy the bond at a discount. You may still want to invest. You're still going to earn a return. But the company will not receive the funds it wants, of course. And of course, the opposite is true. If the company was willing to pay you more than you wanted, maybe because interest rates in the economy have gone up since the bond was issued, right? The whole process then is backwards, right? Is the other way around. This bond would sell at more than $1,000 because it would then be selling what we would say be selling at a premium. Let's look at the calculation for callable bonds. In this case, we have this 10-year bond, $1,000 par value, 10% annual coupon. It's selling for $1135.90, has an 8% yield to maturity. It can be called after 5 years for $1,050. So as we see, we plug in the data. For this bond, the current yield to maturity is 7.97%. If we input the data for the premium, for the call, the yield premium is $1,050, and the time to call is 5 years. This helps us then calculate the yield to call. In this case, 7.51. So when would the company call? It would only call if interest rates could fall far enough to reduce the total cost. As an investor, you want to think about the chance that interest rates fall far enough that the price of the bond ultimately would go above $1,050. So in general, if a bond sells at a premium, that means the coupon's greater than the required return, so a call is more likely. So again, on premium bonds, you typically expect to earn the yield to call. And on par and discount bonds, you typically look to earn more money on yield to maturity and par and discount bonds. One last area for the end of this video is we want to look at how interest rates are comprised, or what are the component parts. Now, I think this is a theoretical breakdown, but this formula represents the basic variables that influence the cost of any asset. So here we're just concentrating on debt. So the real rate is created at the economic level with supply and demand of money. And of course, we're all aware of inflation. We understand what inflation is. Maturity risk is about the length of the loan. The longer the loan, the higher this premium. The default risk premium relates to the chance that the firm will go bankrupt. And again, the greater the risk, the greater this default risk premium might be. And then finally, the liquidity premium refers to the ability to sell the debt and maintain its value. If a company is very popular, lots of investors are interested, its bonds might be more liquid than some other companies might be. So let's look at just one component of this, which is the real risk-free rate. This is the hypothetical riskless security that pays each moment if zero inflation were expected. So the R star here, the real risk-free rate, changes over time depending on economic conditions. And we can approximate this by using short-term Treasury inflation protected securities. called TIPS. So the rates on United States Treasuries are typically used as a proxy. So if you have a short-term investment, you might want to use a T-bill as your risk-free rate. For a long-term security, you might want to use a Treasury bond. So that's the end of this video. We'll chat in the next one. Bye-bye.